So option A says, as that money continues to increase and as they make, let's call it $500,000 off your 120, God forbid if something happened to you in 20 years, your beneficiaries get 200,000. They keep all the rest. That's option A. That's what most of us have. Option B says, as you continue to contribute to your account and as that cash value grows and as the life insurance company compounds that 120,000 and turns it into $500,000, you get to use it. You get to leverage it and take it as income. You get to leverage it and do infinite banking. You get to leverage it, take action and build wealth. Put yourself in a position to where you can fire your job. Option B says you get to leverage this money, not just the life insurance company. So why wouldn't any policy you have these two features? The objective today is kind of just break down. This is a conversation we've had many times, and it's in relation to the example that we covered a couple weeks ago, or consistently over the last two lives, and that is taking a dollar amount, freeing up cash flow, and then putting that cash flow to work inside of a secure compound interest account. And so ultimately, before I kind of jump into that, I just wanted to reiterate something again. This is information that we share often in this space. And that is, for those of us who are focused on building wealth, what are those vehicles today that you are aware of that will put your money in a position so that you can generate and or build wealth? Like, what are those vehicles? Because one of two things are happening. Either that vehicle is tied to the stock market or it's not. And so what are those vehicles that allow you to generate wealth that are tied to the stock market? So we're talking about anything that's market-based. So retirement accounts, IRAs, 401ks, 403bs, TSPs. If you're investing in ETFs, however you're doing it, your Robinhood account, the stock market has made many millionaires and many billionaires and will continue to do so. But what is that formula around how wealth is generated in these vehicles? It's a simple formula. And that formula looks like this. Well, when we talk about those vehicles that don't involve, or at least you're able to reduce the factors that impact this up and down performance when you're dealing with the market, what is the difference between the equation between these two vehicles? It is literally one variable, and the variable is located here. It's the ability to reduce risk. The difference between these two equations is this minus sign. This minus sign implies risk, meaning when your money is in the market, there is a possibility that it will increase over time. And there's also a possibility that it will decrease over time. And that recovery period impacts your ability to be able to build wealth. Like, imagine being here and then all of a sudden dropping here, and now this is where you're going to retire. That means you have to wait till this point before you can at least just in general get back to where you were. Look at the number of compound cycles it would take to be able to do that. Well, what if you were able to reduce the risk? So, okay, if this is how you generate wealth and this is how you generate secure, uninterrupted compound interest, what are those vehicles that you can put your money in that will allow you to accomplish that goal in this vehicle? And specifically, let's break down that equation. The equation that I'm referencing is this. It's the ability to pay yourself first in a vehicle right now, today, and that vehicle being secure, meaning we're able to reduce, if not eliminate, that risk so that your money's secure. You don't have to worry about putting your money in this vehicle and it not being there. And then you compound your money. That's your money making money, and the money that your money makes more money. And then the ultimate is then you exponentially grow it by adding someone else's money. So leverage, adding leverage to the money that you're growing to be able to produce more. What are the vehicles that satisfy all of these variables? There's not a lot. We're talking like, okay, let's talk through them. Real estate. Are there real estate related vehicles where you can pay yourself first, immediately, secure your money, compound your money, and use other people's to grow it? Absolutely. Like, real estate is one of those areas where, again, barring a 2008 type circumstance, you can absolutely build wealth over time exponentially. Outside of real estate, what are they? Like, what is the name of them? There's not many. But then we kind of highlight a secure compound interest account that absolutely fits in this equation. And so that's kind of what we want to talk about, or I'm going to spend a little bit of time talking about and breaking down. And again, you've seen this before as well. All of our money, meaning all of us have some type of income that we make, whether it's Social Security pension related or our W-2 wages. Where does that income go? Well, usually it goes in one of two places. It goes into our home, or it goes into some nest egg that will at some point be there for us when it's time to retire. And then for those of us who are in retirement or close to retirement age, maybe we're making less earned income, but our retirement income is also going into these same two places. So what we've been educated, taught, what's been ingrained in us is we will do whatever we need to with our income. We will do whatever we need to with our retirement account to be able to save our home. Meaning whatever. How many people do you know who will borrow or take the tax and penalty hit from their company's retirement account just so that they can buy their home? Like it's been normalized. But how many of us know someone who will actually leverage their home to build wealth over time to be able to be able to live off? Meaning, how many of us will leverage the home that we're in to be able to generate retirement income? And then also leverage the income that we're making to generate that retirement income. It's a paradigm shift. And it's very difficult to explain if you don't understand the how. So, what we want to talk to today is the how. What we're referencing is a secure compound interest account, premium finance strategy. Some people call it MPI. It has a lot of different names, but the bottom line is it's a life insurance product that's designed to produce income. But what does that even mean? Like, what does a life insurance product designed to produce income even mean? What I'm talking about is an IUL, that is max funded. It has to be option B. What does that even mean? Again, the base of it is an IUL, and we're adding leverage. We're adding someone else's money to be able to generate and or build wealth. Again, it's a life insurance product, properly designed, properly structured for you to be able to build wealth. Where do those exist? How can you get one? Why aren't all structured this way? Like, what does this even mean? And when you talk about max funded, what am I saying here? Max funded is simply saying we're purchasing the least amount of life insurance legally possible. Why? Because the less life insurance you buy, the less expense to you. The less expense to you, the less money the life insurance company is making, the less money the guy that sold it to you is making. But there's more of your money that's actually working for you to help you generate wealth. Again, I'm a retirement planner. I'm a retirement consultant. My job is to make sure you're building income. So wouldn't you want to be in a product that is with the least amount of fees so that the maximum amount of your money is working for you? Like, it's just common sense. But why aren't all life insurance based products designed this way? And for that, you have to ask yourself who benefits with it not being that way. So that's max funded. Option B. This is not a term that I created. Option B is a life insurance term. Some people call it option two. So option B or option two, same thing. Well, what's the difference between option B or option A? I'm sorry, option B or option two versus option A or option one? What's the difference? Well, can we just start here? Would whoever came up with this term have called option one or option A, wanting that to be the first option? Would they have not called it that if they didn't want you to choose that first? Just on the surface. So whoever created the terms option A and option B, they wouldn't have called it option A if they didn't want you to choose the option A version first. So what does option A even mean? Well, any of you who have any type of life insurance, 9 times out of 10, the life insurance you have, if it's general based life insurance from a State Farm, Allstate, that life insurance is option A. What does that mean? What option A is saying this: as you're contributing to your life insurance based policy, call it $500 a month. As you're contributing your $500 a month, you're buying a certain amount of life insurance. That life insurance could be a term policy, whole life, doesn't matter. God forbid you step outside your front door on day one, get hit by a bus, your beneficiaries are going to receive whatever that death benefit is. Call it $200, $200,000. So $500 a month, buying $200,000 in life insurance. Pretty simple. Well, if you're putting in $500 a month, $6,000 a year, $60,000 over 10 years, $120,000 over 20 years, how much life insurance how much money did you put towards that life insurance policy? $120,000 over that 20-year period. What did the life insurance company do with that $120,000 over that 20-year period? Can we agree that the life insurance company is compounding your money? They are putting your money to work. They would not allow you to get a life insurance policy and not make money off you. So their bet is you're going to live beyond these 20 years, and they're going to take that $500 a month and get it working and make more money off that $500 a month than the offer that they're making to you as it relates to life insurance. So option A says, hey, as that money continues to increase and as they make, let's call it a $500,000 off your 120, God forbid if something happened to you in 20 years, your beneficiaries get 200,000. They keep all the rest. That's option A. That's what most of us have. But option B says something different. Option B says, as you continue to contribute to your account and as that cash value grows and as the life insurance company compounds that 120,000 and turns it into a $500,000, you get to use it. You get to leverage it and take it as income. You get to leverage it and do infinite banking. You get to leverage it and take action and build wealth and put yourself in a position to where you can fire your job. Like that's what you get. So option B says you get to leverage this money, not just the life insurance company. So why wouldn't any policy you have these two features? Who benefits if you don't? And then obviously the foundation of this is an IUL. Why? Why is the foundation of a product like this built inside of an IUL versus some other product? It's about security. The only guarantee a product that an IUL or an IUL type product has, the only guarantee inside this product is this: the money you put in it cannot be lost due to market risk. That's the only guarantee. But for someone like me, someone my age, someone focused on making sure I'm not losing the money that I'm making, meaning someone who is not participating in this up and down performance, meaning, hey, I was here, I thought I was going to retire, but now I have to recover. For someone who doesn't want to participate in this, I want security. I want to be placed in a position to where when I put my money away, there's a contractual guarantee that I can't lose it. Is there a contractual guarantee in your 401k that if the market crashes, you don't lose the money that you already have inside your 401k? Doesn't exist. So if the goal is to generate wealth and the goal is to reduce or eliminate that risk, I want a vehicle that as my money is growing, there's some guarantee that I have that I at least won't lose the money that I've made. And that's what this product is.